Welcome back to another episode of the Meet Kevin Report. Let's go ahead and start with what's going on with this Binance lawsuit, because we've got the lead chairperson of the Commodity Futures Trading Commission on CNBC right now. Let's listen in.
Derivatives to U.S. customers and intentionally evading requirements to register with the CFTC as both a broker, as an exchange for both swaps, futures, and options. So this has been a long-going practice. It's a clear, intentional method to evade law. And because they're offering to U.S. customers, we felt like this was an important case to bring and sending a clear message across to crypto exchanges and crypto participants across the world.
Binance and others have said that they would welcome regulation that allows for a clear path. But I think some of the things that you laid out in these charges that you're putting forth are more than just kind of accidentally wandering into a violation of the law. This looks like it was pretty orchestrated, at least from what you've put out.
Yeah, in the complaint, it's pretty clear that this was, to use your word, orchestrated, and there was an intent to evade U.S. law. And there are communications that are documented in the complaint as well about how to evade, a virtual private network or create a VPN to get around the barriers with the internet to have U.S. customers access these markets across the globe, and different entities set up overseas with really not much in terms of funds coming from non-U.S. entities, U.S. control persons involved. And it seems to be a pretty classic example of a very clear evasion, a very intentional evasion of U.S. law. And given the volume, given the size of, as you pointed out, Binance in terms of crypto markets and crypto volume, this seemed to be a pretty clear a case of evasion, and something that we needed to step in aggressively with and do it as quickly as possible, because this was an ongoing fraud going back to 2019, an ongoing violation of the Commodity Exchange Act.
Fraud.
So we felt that we needed to move as quickly as possible.
We're going to go through the lawsuit in just a moment.
That a company would say, hey, these were some rogue actors who were doing this. In this case, you lay out in the complaint that this went straight to the top, to CZ himself. You have commentary or an exchange from one VIP team member who was trying to court some of these U.S. market players, saying, hi, CZ, I went through a list of affected API clients. It includes a number of large strategic accounts, including, redacted here, a Chicago headquartered trading firm who is currently a top 5 client and 12% of our volume. Zhao's response to that is give them a heads up to ensure they don't connect from a U.S. IP. Don't leave anything in writing. They have non-U.S. entities. Let's also make sure we don't hit the biggest market makers with that email first. Do you have Signal, which is a way of privately transacting messages back and forth that you can't track? If that's the case, if this went straight to the top, what would an appropriate punishment be?
Ooh. Well, as we're a civil enforcement agency, and I think to your point, and something that has been pretty well known in the crypto circles now, is that, and I've said this in my statement yesterday, not having a headquarters, not having a location is not going to prevent the CFTC from coming after you. And in this particular case, as I said before, there was a clear evasion. And when we looked at the entities, it is a common enterprise, dozens and dozens of entities scattered across the globe with control persons up to Mr. Zhao. And when you have that situation where you have a control person of a common enterprise, I think there's clear potential liability that we saw. And as you pointed out, clear documentation of an intent to evade law with a very clear, direct method of saying, this is what we need to do to evade U.S. law so that we can have access to the market. So we feel pretty confident in this case. Obviously, something that we care about deeply and that we've been on top of for several years in this crypto space. I've been on the show with you talking about a lack of authority for the CFTC in the commodity crypto space. And I think this just demonstrates the need for clear rules, but also authority so that we can avoid situations like this and make sure that we're creating transparent markets so that U.S. customers are not subject to fraud or manipulation.
If you are successful in bringing this complaint, would you ever allow Binance to come back and be a regulated derivatives provider in the United States? Or does this prevent them, this bad behavior, prevent them from...
He just called him a fraud.
That authority from you?
Well, it's a good question, and in the complaint, we request disgorgement of funds a ban on trading and registration, a civil monetary penalty, and then also a permanent injunction. So depending on how the case plays out, that could be a situation where there would be a permanent ban for both trading and registration in the U.S. By the U.S. CFTC.
And Mr. Chairman, I don't want to, I guess I can't ask you to draw conclusions, but in terms of whatever lapses, or even knowing maybe that this was, not a good thing to allow to be happening, do you think that you can take that to other parts of the Binance business? Do you think it points to a possible, I don't know, could there be standards that are corners being cut in other parts of the business that would be more worrisome? Do you know if there's anything? I'm asking you to draw a conclusion. I guess you can't really.
Yeah, I mean,
does this raise eyebrows
right.
about maybe other more even worse things that might be happening at Binance?
Joe, I think inevitably it does, in the sense of, if there's a trail, we need to look at it, we need to examine it. But I'll say, as chair of the CFTC, I have to live within the four corners of the Commodity Exchange Act. So I feel like this complaint exhaustively uses the authority that we have at the CFTC to make sure that we're going to prevent this activity from continuing in the future, and making sure these individuals who are intentionally trying to evade the law stop doing that.
All right, so what is the next step in this trail? You were talking about a company that's international, not based here in the U.S., but in the documents that you've put forth, you're talking about a Chicago headquartered trading firm, the name's been redacted, that they say was currently a top 5 client at 12% of our volume. Do you go after the players that are domiciled here in the United States that were clearly trying to evade the law as well?
Well, I'm not going to discuss that at this point. The focus of this complaint specifically is Binance, the two individuals, both Mr. Zhao and Lim, who are the chief compliance officer, and their intent to violate the U.S. law. At this point, that's going to be the focus of the charges and the litigation going forward. And obviously, there's a counterparty to that, but right now we're going to focus on Binance, because that really is the source of the violation of the Commodity Exchange Act, and where the case will focus on.
And Binance's response to you so far?
I haven't seen. I think there's been some press release or some very public quotes about disappointment. But the fact of the matter is, and Becky, as you read yourself, the evidence speaks for itself. So we're going to vigorously continue and fight this case in court, and hopefully justice will be brought in this case, because I think the facts speak for themselves. And as I've said before many times, this largely unregulated market that is speculative, obviously institutional investors, but a lot of retail investors as well. There's a lot of risk, there's a lot of volatility. And in this market environment, I think it's just incumbent on regulators to work vigorously and hard to make sure that we're stopping this activity, so that we don't continue to see this illegal activity, this volatility, and ultimately loss of customer money.
Meaning that the Congress still hasn't acted to really give a clear regulatory framework. So both you and the SEC are going to continue to do what you can within the purview to this point. Can we assume that this is the first of many other actions to come from the CFTC?
Well, look, CFTC has been bringing crypto cases going back to 2014, and across the board in terms of individuals and institutions. This is just another case that I think is a continuum of what we've been doing. And as you said, we will use the authority we have to the fullest extent of the law to make sure we're bringing bad actors to justice.
Chairman Benham, thank you very much for joining us this morning.
All right, that was the chairperson of the Commodity Futures Trading Commission. So let's go through some of the lawsuit and response from Binance. So let's go ahead and do that. This is actually a really interesting case. So give me a second here. All right. Well, Binance is getting sued, and in this segment, we're going to go through the lawsuit and response from CZ himself. I've also covered this Binance saga for quite a while, with just 2 days ago breaking down a video from CNBC where CNBC alleges that Binance basically helps people skirt Chinese laws to make sure that Chinese individuals can actually invest in crypto by skirting the rules or purposefully closing their eyes to regulations to let people sign up for Binance in China, even though they're not allowed to do that. Even going as far as basically allowing people to upload Chinese passports and identifying documents, but saying they're from Taiwan, even though their documents clearly say they're from China, but then purposely ignoring those documents. That was a CNBC cover just a couple days ago. Going back a year ago, we have a Bloomberg story talking about how CZ purposefully lives in Dubai and refuses to come to the United States, potentially because he's afraid of getting arrested, stays in Dubai because they don't have extradition treaties. Most of his companies are based out of foreign countries. There are over 150 different entities, but many of them based in the Cayman Islands. Very difficult to actually figure out which company or entity to sue if you're an individual trying to sue Binance. And so there's been a lot of coverage obviously around Binance, and every time we cover Binance, there are an army of either crypto enthusiasts or bots who refuse to provide any kind of data or facts and just provide their opinion of why they think it's wrong. The government or entities might potentially be sued regarding crypto. Now, something to keep in mind as well, on top of this, sort of just summarize some of the things we've recently talked about, we also know that now up to about 80% of Bitcoin trading volume takes place on Binance. A lot of that may be due to the fact that Binance removed all trading fees around Bitcoin, which was a smart thing to do right around the collapse of other brokerages. Brilliant move. But it also makes you question that this is a company that's removed a proof of reserves audits, which could have been the same bucket of $1 billion to multiply and reserve out multiple different stable coins, which we don't actually think are fully backed at Binance because we've never seen a complete audit over at Binance. So I personally find it very difficult to trust any part of Binance. But let's take a look at now CZ's response to the Commodity Future Trading Commission's lawsuit against them. We're going to start with CZ's response, then we're going to dive into the actual lawsuit. So today, the Commodity Future Trading Commission filed an unexpected and disappointing civil complaint, despite our working cooperatively with the CFTC for over 2 years. Upon initial review, the complaint seems to be an incomplete, basically list of facts. Binance has developed best-in-class technology to ensure compliance. Binance is the first non-U.S. exchange to implement mandatory Know Your Customer programs and remains to and has high standards in anti-money laundering and Know Your Customers. We block U.S. users, IP addresses, VPN endpoints, mobile carrier, device fingerprints, bank deposit and withdrawals. Basically, they talk about all these fantastic things that they do to make sure that they cooperate with the law. We are aware of no other company using systems more comprehensive and effective than Binance. And basically, a full response will come in the future. This is CZ's response to a massive lawsuit by the CFTC seeking to permanently ban Binance from being able to operate in the United States. And there's some massive quant funds that operate using Binance in the United States. That's what's important to remember is there are massive trading firms trading billions of dollars in the United States with Binance as the platform, and they're using algorithms that they tweak every single day just a little bit to make sure that they can dump and pump on normies as they wish. So if you're trading less than 1,000 BTC, you're almost irrelevant, unfortunately, in the world of the quant funds using Binance to manipulate or trade markets. Now, what is the CFTC's complaint? Well, first, the CFTC alleges fraud against Binance and suggests that Binance, much like FTX did, could potentially be using customer deposits in ways that are not appropriate, such as potentially investing them. But let's go through the actual lawsuit here and let's look at some of the highlights because there are some pretty juicy pieces in the actual lawsuit. Let's start with some of them right over here. So we're going to go to page 32 of the lawsuit here and take a look at this. There's the Chief Compliance Officer Lim that you're going to see referenced. And then you're going to see Zhao, which is CZ, the CEO of Binance, whom, according to the CFTC, basically controls all of Binance. And listen to this. Binance intentionally tried to hide the scope of its compliance program ineffectiveness from its business partners. For example, around October of 2020, Binance underwent a compliance audit to satisfy a request from Paxos. But according to the chief compliance officer, Lim, Binance purposefully engaged a compliance auditor that would, quote, just do a half-assed individual sub-audit on geofencing to buy us more time. Uh-oh. Here's I'm getting hit by the Chinese who really like Binance. There we go. All right, fixed. As part of the audit, the Binance employee who held the title Money Laundering Reporting Officer lamented that she, quote, needed to write a fake MLRO report to the Binance board of directors. Binance didn't even have a board of directors. Lim, the chief compliance officer, was aware of that and replied and says, yes, it's fine. I can get management to sign off on that fake report. The chief compliance officer themselves literally sent the following message. I has no confidence in our geofencing. And then they're literally caught joking about illegal terrorist organizations like Hamas trading sums of money that might not even be enough to buy AKs with, but they're joking about how we basically see crime happening on the Binance platform, but they just keep their eyes closed to that activity. In fact, when they would talk about, quote, we're very closely associated with illegal activity, or rather recent transactions by a certain customer were, quote, very closely associated with illicit activity, and over $5 million USD worth of his transactions were indirectly sourced from questionable sources. When an employee asked about this, the chief compliance officer responded with the following: can let him know to be careful with his flow of funds, especially from darknet like Hydra. He can come back with a new account, but the current one has to go. It's tainted. You literally have fraud documented inside Binance. Now, we know right now these are all just allegations, but the CFTC is alleging via these chats that they got from employees, even though they use Signal and most of the chats get deleted. You literally have fraud from within Binance about how they know people are illegally operating within Binance. They're just like, just have them use a different account. So they know about it. We don't need to be strict because CZ doesn't like offboarding. Offboarding is a reference to people leaving and going to a different platform or whatever. Here, the chief compliance officer says, hey, I know it's a pain in the butt, but my duty is to constantly remind you. And they basically talk about sanctions and the potential international risk of getting caught if they're doing shady things, basically. And an investigation could blow up big on the world stage. And basically, they acknowledge these problems. And what they do is they just take out any references to the United States on their platform. So that way they could potentially skirt regulations even more so. Here's just how they use VPNs, much like the CNBC story broke, to try to encourage people to get around the know your customer rules. But take a look at this. Binance's revenues reportedly rely on data drawn from Binance's internal databases. Monthly reports from revenue from 2020, and they have more from 2021 as well, basically show that a certain number of customers were from locations labeled UNKWN, which is supposed to imply unknown. But actually, listen to this. The same month, rival digital asset exchanges were sued by the CFTC. So the CEO directed Binance personnel to replace U.S. values in data fields with the value unknown. As a result, Binance's October monthly revenue reports identified 2.83 million customers in locations known as unknown, while omitting any reference to the United States. In other words, listen to this. It's widely understood by Binance personnel that unknown is a code word for the United States. Dang it. Let me fix that really quick. There we go. And it's basically purposefully used to skirt the fact that they have exposure. What is stupid cable here? They basically use unknown to purposefully skirt the fact that they have customers in the United States. They say, quote, everyone in the future will not see our U.S. data except for very few people Instead, we'll just use the word unknown every time the US is referenced. That's on page 46 of the complaint here from the CFTC. So it's very obvious that they know what they're doing is wrong, and they're not providing the reporting that they should to US authorities. In fact, the CFTC alleges that Binance has never once submitted a suspicious activities report, which is something if you actually had good compliance procedures or cared, you would do. But we already know that Binance says they have compliance, and they don't care about actually following through with their compliance. They themselves don't care about their compliance. Now, some people say, hey, who really cares? Like, let crypto be crypto and decentralized. But the whole point of having regulation is to make sure that people's deposits aren't affected and that stable coins that are actually backed by a dollar are actually backed like a dollar. Or backed by a dollar, but we don't know that that's true. And so it's a really dangerous platform to be on. You know, I understand some people internationally have to use it because they don't have another choice and they want to get their money into crypto. But golly, not your keys, not your crypto here. I'd have my money off of Binance for sure. I'd have my money off of any exchange if I was in crypto, which I'm not. I think it's too manipulated by stuff like this. Look at this. Here, there's a whole section about how Binance employees basically talk about how they have to keep an eye on gamifying crypto trading. And they say the following: good Lord, I'd never have this many problems. It's just as soon as I talk about a crypto video. Right now, most of the gamification trading are based on some complex derivative financial instruments such as binary options, exotic options, or perpetual swaps. The reason why we did the futures battle is we wanted to lower the barrier of complex financial products. So here's basically where Binance is talking about this gaming feature they have called Futures Battle, where you can like fight people on a 1-minute battle period in terms of which direction crypto is going to go on potentially as much as 125x leverage. And Binance employees themselves say usually this kind of products look like gambling. That's actually, by the way, a very common misspelling for somebody where English isn't their first language. Usually it's these kinds of products, right? Anyway, usually this kinds of products look like gambling, which may bring us some compliance and reputation risk. So we need to make sure the product does not look like a gambling game. User might be easier to get addicted to these products. So we need to enhance responsible trading, or you could say playing as well. So they know these products are gambling. They know there are dangers with these. But listen to this. At various times during the relevant period, some of the entities have entered into over-the-counter transactions with Binance customers, such as settling trades and basically moving deposits directly into counterparty accounts. In other words, deposit mismanagement. This is pretty scary, some of these allegations here by the CFTC. And so it's going to be a little oopsie-doopsie for Binance to deal with, especially since the CFTC is basically going for their throats, trying to potentially completely ban Binance. They say here that since the launch of Binance in 2017, Binance has taken a calculated, phased approach to increase its U.S. customer presence, despite publicly stating that it intends to block or restrict customers. This is the same thing that they always do. They tell you they have the best and world-class know your customer rules and VPN blocking rules to your face, but then behind closed doors, they basically allow people they show people where the back doors are and skirt compliance programs. They know the programs are ineffective, and the reason they know the programs are ineffective is because their position is, well, it's a business decision. The more customers we have, the more money we make. Look, in August 2020, they made $63 million in fees. In May of 21, they made $1.1 billion in fees. And the CFTC is basically saying they're purposely trying to avoid regulation, deliberately skirting rules because it's profitable to do so. And to some extent, yeah, that's true. It's extremely profitable to do so. But it also sets up a potential house of cards that basically CZ runs. And there are a ton of bots who suggest this guy's like some kind of hero for crypto or whatever. But what he really is potentially, as the CFTC said, a fraud. He's probably very little different from Sam Bankman-Fried, who was a complete fraud. And people like this deserve to be in jail. There's a reason this guy is not willing to come to the United States because he knows he'd end up in prison. He's hiding in Dubai for a reason. And you know what people like this do? I mean, just look at what the last dude did, Mr. Kwan, who was just arrested. Basically, what they do is they wait. The United States waits until these people are arrested, and then they actually file the criminal charges against them. This guy, Kwan, was on his way to Dubai, almost made it to Dubai on his fake passports, gets caught in Montenegro, an Eastern European country. The day after he's arrested, what happens? Boom! Gets all the criminal indictments against him from the United States. So I think one of the reasons the U.S. is so anti-crypto right now is because the entities that are running it are basically in-your-face frauds. And the U.S. is just gearing up to try to do whatever they can to take down to stop the fraud. They don't want people to lose money. They're going as far here as actually calling BTC, ETH, LTC, Litecoin, and two fiat-backed stablecoins, Tether and Binance, commodities, basically allowing them to have jurisdiction over the regulation for all of this. So, rip Binance. I don't know. There's a reason I've been very interested in good cash flowing companies lately. I know people are like, oh, but there's all this fraud in regular stocks and manipulation as well. Yeah. Well, two wrongs doesn't make a right, as they say. So, but this, I mean, more and more, everything that stacks up about these crypto companies that are off U.S. shores, Binance, FTX, more and more about them is just pure fraud. I have much more empathy for a company like Coinbase, where Coinbase at least is here, U.S. regulated, U.S. listed, and they're trying. Now, just because they're trying doesn't mean that they're actually going to win over here at Coinbase, especially since now they're getting sued by the SEC, which is quite unfortunate for them because they have a pretty long response letter about how frustrating and painstaking it's been for them to work with the SEC and how many proposals they've given to the SEC to try to basically publicly be able to list ETFs. Here's their piece on this. Now, this is obviously the Coinbase side of it, where they really try to get proper regulation complete. Coinbase is trying to go in the legal direction. Binance is going in the illegal direction. And you can't really blame Coinbase because they've had so many frustrations and so much money on dealing with the SEC. Now they're getting this Wells notice about a potential investigation coming. The problem is, I really think you need Congress to dictate, are these commodities? Are they securities? Who should regulate these? And what should the rules be for regulation around crypto? And then people should be able to follow the rules, right? I think it's very difficult to say, like, there are no rules, and if people do something that after the fact we don't like, then they get sued, right? I think that's problematic, and that's probably not the best form of democracy. But then again, democracy is really based on these kind of people like Kevin McCarthy over here talking on CNBC. And the problem with them is they can't get anything done. So the politicians are hamstrung. Congress, therefore, is hamstrung. And therefore, the agencies are hamstrung. Nobody can really do anything. So basically, what they're trying to do is they're trying to litigate the regulation for Coinbase and Binance through courts. That's what they're trying to do. They're trying to create law through the courts. You ever heard of case law, right? So you take the SEC, make all of their complaints against Coinbase for things that they want law. The CFTC make all of their complaints for things that they want law against Binance, and then get a court, potentially, eventually the Supreme Court, to rule on it. And now you can actually get rule of law without the act of Congress. So that's really what's happening here. But some of the allegations against Coinbase will probably just clean up Coinbase. Some of the allegations against Binance will probably lead CZ to have an arrest warrant out for him for the fraud that's being perpetrated at Binance. So it'll be really interesting to see how it all evolves. I think it's quite interesting. But anyway, that gives you an update on all the insanity that's happening with Binance. And if any of that makes you nervous, make sure to get life insurance in as little as 5 minutes via the link down below. It's one of the sponsors here. Take a look at this. You can also go to meetkevin.com, learn about my courses. You can now use buy now, pay later for the actively managed ETF, real estate startup, affiliates, and all that good stuff. So that gives you a little bit of insight into the Binance lawsuit madness. Oh well. All right, let's now take a quick listen in to see if Kevin McCarthy's saying anything interesting.
I think there's a real concern here with the growing rise of China, their desire of what they want to do. And I think as policymakers, if you have information and you don't protect the American public, you're not doing your job. If you're more concerned about getting votes than it is about securing the nation itself, that's a concern to me. But I believe there are votes on both sides of the aisle to change TikTok as it currently stands today and to protect the American public on their data moving forward.
All right, Mr. Speaker, thanks. And please be in touch with us if things start moving, if people start talking, you and the president, about how to handle this. I think the markets are watching. And you know how time flies, it goes very quickly, and this is coming straight at us. So, Speaker McCarthy, thank you.
Thank you
for coming on Squawk Box today. Okay.
When we come back, what to expect a little later this morning when senators dive into the collapse of Silicon Valley Bank. And we will get into the question of whether financial firm rescues are ultimately a good thing or a bad thing with Rockefeller International Chairman Ruchir Sharma. Stay tuned. You're watching Squawk Box, and this is CNBC.
Oh, I love their music. It just brings back the good old days. Anyway, now we got to talk about the fallout from the banking crisis. So banking crisis fallout. That's what we're going to call it. And let me get that up here. Don't you love waiting for Kevin to get it up? Here we go. And it is, hold on, this will just take a second. Let's make sure, yeah, that's AI. We'll talk about that later. Got it. All right, here we go. Goldman Sachs has opinions on how bad this global banking crisis is going to be. And they give us some breakdowns of where exactly we think some of the pain is going to be and where the pain won't be. And they actually give us a breakdown of 5 explanations on how this banking crisis could affect us. And these 5 things are actually pretty neat to understand because they could give us a little bit of guidance on how to invest going forward. Now, I think you all know this already. Even though I'm a licensed financial advisor, the information in the videos is not personalized financial advice. But my thesis lately has been that I think a Nike swoosh recovery is underway. That is, peak fear occurred somewhere between June and October, where we really thought we were going to get Paul Volckered. Ever since the inflection point in inflation, those fears largely went away. And my belief is that the best stocks to invest in between now and when real estate bottoms, when it makes time to transition or potentially makes sense to transition to real estate, between now and then, I think the best strategy is investing in pricing power stocks, companies that have high free cash flow and ideally are profitable. The reason you want high free cash flow and profitable is so that they don't have to raise money, potentially because of negative earnings. Although they do have high free cash flow, they might still have to raise money to invest and continue to expand in growth. So if you get that combo of high free cash flow and positive net, that could be a nice way to get through, especially if you're focusing on those wealthier companies or individuals and where they might be spending, because they might have the most ability to spend through a recession. With that sort of recap done, it's important now to look at exactly what Goldman Sachs thinks about this banking crisis. And I really think this breakdown is interesting because a lot of people are freaking out about this idea that we are definitely going to see a big slowdown and a massive credit tightening that is just going to worsen the recession. I was talking about this yesterday, and according to NatWest, we haven't actually yet seen a short-term tightening in credit conditions. And that made me really interested because I was talking with my team and I mentioned, hey, we haven't seen a short-term slowdown or tightening of credit conditions. And since we haven't seen a tightening of credit conditions, why do we expect a worse recession? Why do we think credit conditions will tighten in the future? And our thought was, well, it'll probably come, right? Like credit conditions will probably tighten and crush the economy, right? Well, maybe not. Let's take a look in here to Goldman Sachs's view. So they say right here, it's still too early to have a very confident view of exactly what's going to happen. Our baseline expectation is that reduced credit availability will prove to be a headwind. So in other words, a reduction in credit is likely to happen, but so far it actually looks like it might just be a headwind rather than a hurricane that pushes the economy into recession and forces the Fed to ease aggressively. Now, because of this banking crisis, Goldman Sachs is actually moving up their opinion that we're going to go into a recession from 25% to 35%. So they've actually increased their opinion that we're going into a recession. No, they're very low on the recessionary standard. There's a 60% consensus estimate that we're going into a recession. These are all of the estimates right here on forecasters who think we're heading into a recession. Goldman Sachs is over here at just 35%. Whereas the median forecast is 60% chance we're heading into a recession here. But they say here that, yes, there are risks skewed to the negative, that credit tightening could be worse than we actually think it will be. So it's possible things could go bad. But it seems like credit tightening might just end up being a headwind and not a hurricane. And they give 5 reasons for that. And of course, they do think that ultimately GDP growth will be hit by about 4 percentage points. GDP dropping from about 1.5 to 1.1%, but that's not recessionary. That's still clearly above zero. Zero is where you get to recessionary. So why are the numbers not bigger? And here are the 5 reasons. And I'll tell you, they are fantastic explanations on maybe why the banking crisis won't be as bad as actually thought. And I really have been looking for reasons like this because the last couple weeks I've been a little frustrated with how little literature there is on credit tightening. And I'm thinking to myself, like, hasn't there already been a lot of credit tightening? Is there really going to be a lot more because some risky banks failed? So that was my concern sort of in the back of my mind, like, are we being too bearish here? So what does Goldman Sachs say? And I thought this was really interesting. Why are these numbers not bigger? First, banks have already been tightening their credit standards since mid-2022. So the incremental impact of the recent turmoil on credit availability and growth should be much smaller than the situation in 2008, where the prior expansion was largely built on easy credit. Relatedly, the private sector runs a small financial surplus today. So first big thing, hey, we actually have already been tightening credit standards. So just because some risky banks are going away, who cares? That might not actually change anything. On top of that, the private sector has more cash today than it did in 2008. In fact, in 2008, businesses in the private sector had a, quote, sizable deficit, whereas today we actually have a small financial surplus. Next, I guess that's part of reason number 1, according to them. So, okay, fine. Second, we do not expect larger banks, which have high capital and liquidity standards, to be and are subject to more stringent stress tests, to reduce loan supply further. They do not expect big banks to reduce loan supply further. Keep this in mind, sort of anecdotally. If I go to a big 4 bank, and I've done this in my career, and then when I finally realized what the rule was, I stopped. I remember going to the big 4 banks many times, Bank of America, Citi, Wells, JP Morgan. And I've gone to them, I'm like, hey, I got, a real estate portfolio, 27 properties here. It's worth, $24-25 million. Well, I'd like to refinance the portfolio with you. Oh, we don't do portfolio loans. Okay, how many of them can I refinance with you? Well, we can only do 4 loans. And I'm like, but Fannie and Freddie Mac let you go up to 10 loans per person, which would be 20 loans for my wife and I. And they're like, yeah, no, sorry. Dodd-Frank says we can only do 4 loans. And I basically have to walk out of the big banks because they're so tight. They're so tight, they squeak. And so, like, how much tighter can it actually get at the big banks? They basically suck. And this is why you do, to some extent, want small banks, because it's easier to get home equity lines of credit, portfolio lines of credit. Now, you want to be careful with your cash deposits because you don't want to be subject to potentially taking a haircut on your deposits. That's why we've been having these bank run fears. But this is actually a good argument that how much tighter can they actually get? I agree. Third, Unrealized losses on held to maturity bond portfolios have diminished in the recent rates market rally. Another major difference from 2008, when the problem was that assets lost value during the crisis. Okay, so this is really important to pay attention to. So understand this, and I'm going to make it very, very simple, okay? Let's say this right here is your bag. There we go. This is your bag, and we're going to label it. This is your bag, okay? In 2008, the value of your bag went down because inside of this bag were bonds, and the value of those went down in 2008 during that financial crisis. During today's financial crisis, 23, the value of your bag is actually going up. Yes, the value of your bag is going up in 2023. Why? Because as soon as this banking crisis started, everybody fled to bonds for safety. And so the value of bonds actually skyrocketed and yields fell as people were fleeing to safety of bonds. More depositors were taking money out of deposit and putting them into bonds, which actually increased the value of the held to maturity portfolios at banks. So it's actually a really good point that, wait a minute, wait a sec. This is different because number three, the value of our bags is going up, not down. This is completely the opposite of 2008. Fourth, demand for credit in commercial real estate, where 80% of outstanding bank loans are from sub 250 bill banks, were already under pressure because of post-COVID changes in the real economy. So the incremental activity of reduced credit may end up being quite muted in that sector. Basically, what they're saying here is, after COVID, less people were getting loans from smaller banks in the commercial banking sector anyway, because, well, after all, after COVID, less people wanted to finance new office buildings or commercial buildings anyway. So what difference does it make? Okay, good. Then an immediate source of downside risk would be another deposit run. Keep in mind, deposit runs are somewhat related to retail inventories. Retail inventories just came out this very minute that I'm recording this. Retail inventories month over month up 0.8%. But it kind of suggests that people aren't actually spending money on stuff as much, and inventories are piling up a little bit. Wholesale inventories came in at 0.2% versus the negative 0.1% expected. Retail inventories came in at 0.8 versus the 0.2% expected. So a little bit of a beat on inventories there is potentially people are keeping more cash. But now the concern is, even though people are keeping more cash, they're looking for a yield on that cash. So what are they doing? Well, obviously they're buying no, they're not. Obviously they're moving money into money market funds, high yield savings accounts, or CDs or treasuries to actually get a yield on their cash. Now, keep in mind, one of the reasons you can get a yield on your cash is because, at least in my opinion, there's a huge opportunity cost to being in treasuries or cash yielding accounts right now, because you're potentially missing out on what could be very substantial stock market gains. But then there's a flip side where there's a potential of stock market gains. There's more risk. And that's why that 4 or 5% real yield, right? Or not real, that 4 or 5% yield right now is considered risk-free, whereas your stock opportunity cost comes with a lot of risk, right? Anyway, an immediate source of downside risk is another deposit run. An effective way to reduce this risk would be to basically guarantee all deposits. Fine. Then Goldman Sachs goes on to say, a more subtle risk comes from upward pressure on deposit rates. And this is basically saying that banks are going to have to pay out more money, and it's going to lower their net interest income, their NII. So if their NII goes down to prevent that deposit flight, then bank profitability could go down. There's also the fact that, they believe the Fed should have paused last time, but because of the Fed continuing to go, you could create some more turmoil in markets. However, they're actually optimistic on China, and they're raising their GDP forecast on China to 6% versus the United States and Europe, where they're a little bit more nervous. So what is sort of a conclusion off of this piece? Take a look at this chart. This is actually really interesting too. And then I want to get to the conclusion of this piece. Look at these small bank withdrawals right here, or change in deposits. Massive flight out of small banks right here. I mean, that makes a lot of sense. But what is the point of this piece? Well, this piece is basically telling you everybody's really concerned about, oh no, credit tightening, like it's going to crush our economy. We're going to go into a big, economic crush, and earnings are going to crash even more because of all this credit tightening. There's this potential that all this fear about credit tightening and a massive economic depression because of credit tightening could be the same kind of clickbait when everybody was screaming, oil's going back to $140 a barrel. Just doesn't happen. The reason for that is very simply, small banks have already been lending less because of commercial properties. Big banks already have tight lending standards, so it's hard to tighten them even more. So you might not actually see any material difference in credit standards. Bank bags are getting smaller, not bigger. Big difference from 2008. Private sector businesses have more money today than they did in the past. And the Fed, even though they didn't pause in the last meeting, are probably likely to pause next meeting or certainly the meeting thereafter. And more of those stresses of economic strain could actually be limited. And so this is where they say, reasonably so, hey, look, if we don't have a Paul Volcker, well, then we don't have, the worst case scenario. But on top of that, we might not even get a hurricane like Jamie Dimon forecasted. We might just get some headwinds that basically just slow the economy down a little bit, which isn't that the point? Isn't the whole point of what the Fed's doing to slow down the demand side of the equation, to slow the economy to a level of below trend growth? If trend is 2 to 2.5% growth and we're growing at 1%, there you go. Fed's mission accomplished. So with all of that said, it doesn't seem like the economy actually is going to potentially have this horrible credit tightening cycle that just destroys the earnings of every single company. Instead, it seems like, hey, there are going to be some small effects, but really, do they say get out of markets? I don't think so. And neither does Goldman Sachs. So this is actually pretty positive news. But even though it's positive, you can amplify that positivity by getting 12 free stocks with Webull at metkevin.com/free, and the sponsored link down below for life insurance you can get in as little as 5 minutes, as well as the fact that you can now use buy now, pay later on the programs on building your wealth, linked down below. Alrighty, what's next? I don't know. Let's see what's next.
Republicans pointing the finger at the Biden administration's fiscal spending, and regulators doing a little subtle finger pointing at each other. Sherrod Brown, the Senate Banking Committee chairman, will say the officials sitting before us today know that their predecessors rolled back protections like capital and liquidity standards, stress tests, broker deposit limits, and even basic supervision. They green-lighted these banks to grow too big, too fast. Meanwhile, a spokesperson for Tim Scott.
Yeah, all right, whatever. This debt ceiling stuff is going to get more and more annoying. Max here says GDP now got updated from 3.2% to for Q1. Yep, I totally believe it. Steve says GDP estimates are too aggressive from Goldman Sachs. We'll see. So forecasts are that we're going into a recession, but growing next GDP expectation is still 2.6% quarter over quarter. Well, in fairness, one way you could explain that away is that most of the forecasts are that the recession won't come until Q3, Q4. So yeah, you can have positive Q1, but somehow negative Q3, Q4. But yeah, you're right. I mean, if we're growing at 3% right now, it's going to take one hell of a drop to get into Q3, Q4. That's going to be pretty painful. Let's see here. Where is that flight money going? It's nice you understand how bank is supposed to work and play by its rules. You really should call it the central bank in America. What do you mean, like the flight of money, like the money out of small banks? Well, it's probably going into money market funds, fintechs that are offering high yields, or CDs, which CDs kind of help banks keep some of their deposits. Well, that's probably it. Then you've got, let's see, what was, been waiting for retail to capitulate. Retail waiting for banks to capitulate. Choose your fighter. That's a good point. Oh, this is an interesting one. This is actually a really interesting idea. I want to talk about this. So we've got a channel member with a comment here about stimulus checks, and I think it's a brilliant topic that we should discuss. The potential of stimmy checks coming back to America. Let's analyze this. Garrett Purrington says, if we hit a hard recession with this administration, referring to the Biden administration between now and 2024, they will simply give more handouts one way or another, pushing inflation. The push-pull in 10 years, prices will be skyrocketing. So let's try to break this down and analyze if and how stimulus checks could make it back to the United States. And boy, stimmy checks would be another fun session of video topics that we haven't got to talk about in quite a while. So let's talk about the potential of stimmy checks now. I think the easiest way to do it is draw it out. So let's do it together. First, I think in order to expect stimulus of any kind, we would have to have massive pain and massive job loss. Now, Elizabeth Warren is already expecting somewhere around 3 million job losses. And the way she accomplishes that is by saying, if the unemployment rate today is 3.5%, and the Fed thinks it'll go to 4.5%, the Fed, then the reality is once the unemployment rate goes up 1%, history suggests the unemployment rate will go up another percent. So history suggests we're going to go here. Since we've got just over 150 million people working in America, history suggests we should have about 3 million job losses. At the same time, economic forecasts are really calling for a recession or negative GDP growth sometime in Q3, Q4, right around the holidays. And so call it a holiday recession. See, Christmas sweater, holiday recession. It's almost like I wore this by design. So what could potentially the impact of a holiday recession be? Well, first of all, if we're in a recession, if we actually hit a recession, usually and historically, that doesn't mean that it will happen this time, but usually and historically, the stock market bottoms at the start of a recession. So if the stock market bottoms at the start of a recession and the recession hasn't technically started yet, then pain in the stock market could still be ahead of us. So if the stock market usually bottoms at the start of recession, the only way to really then historically suggest that the stock market hasn't hit bottom yet, or has already hit bottom rather, would be to say that there's no recession, which is possible that there's not a recession. But for the purposes of arguing stimulus checks, let's assume the stock market hits a new bottom. At the same time, we get mass joblessness. That is a sudden wave of 3 million jobless individuals. And that joblessness creates a jobless spiral. Jobless spiral. This is, I think, where the government would want to intervene. Because remember the velocity of money. When one person spends $5 at a hot dog stand, the person who takes that $5 then goes and spends that $5 on an employee to help him at the hot dog stand. That employee then spends their wages on goods and services, car cleanings, a muffler for their car, radar detector for their car, I don't know, whatever they want, food, basic necessities, laundry, whatever. And you have this circulation through the economy. And modern economic thought suggests that when somebody spends money, it usually circulates through the economy about 4 to 5 times. But if 3 million people have less money to actually spend on goods and services, then you could actually take away 4 to 5 times as much money, which would basically means if 3 million people don't have income, you could see the impact of what could be as much as 12 million people without jobs because of the velocity of money amplification effect. Now, obviously, there are employment insurance programs. And this is actually where I think the government could stop a jobless spiral, because if 12 million people were out of work, then earnings at companies are going to plummet. Then they're going to hire less people, and then you get the spiral. Less earnings, they fire more people. They then hire less people, right? So they hire less people, they fire more people, so more people permanently unemployed in the cycle. Less people spending money leads to less hiring, and you basically just have a depressionary spiral. Well, the Keynesian economic thought, which is one that our government and Federal Reserve like to follow, is that, well, if times are tough, we should stimulate the economy. So how might they do that to stop a jobless spiral? Well, there are a few ways they might do that. The easiest way to think about this is, first, how are they likely to continue supporting an anti-jobless spiral regime? Well, first, we know this with certainty already. We expect they would amplify the debt ceiling. It seems like when I type today, this HDMI connector is just trash. I bought a new cable, so I'll fix this for next time. But let's go back here. So the first thing they might do is amplify the debt ceiling, which is basically saying they'll raise the debt ceiling, right? Once you raise the debt ceiling, what can you then continue to do? Well, you could continue to spend on chip-related investments. Why would you continue to spend on chip-related investments via the CHIPS Act, where you could basically just, and you don't even need Congress to do this. Remember this. You could literally have the Biden administration just read the law of the CHIPS Act, where they've agreed to, $80+ billion in spending in chip manufacturing, and they could just loosely interpret it to where all of a sudden, instead of spending $80 billion, they're actually spending $240 billion. Yes, a 3x is possible. That's what Goldman Sachs said in a piece we covered just 3 days ago, where Goldman Sachs thinks that institutional stimulus check spending could actually be 3 times as expensive as previously thought because of the way the Biden administration is interpreting it. So what if they just interpret it so loosely that it's actually a 4 or 5 times investment? Well, now what you're doing is you're creating jobs by going into more debt. That's likely to happen in chips. It's likely to happen in EV. It's likely to happen in solar, hydro, and other scientific-based, in my opinion, investments that the Biden administration can justify under acts that have already been passed. So I think the debt ceiling gets raised hands down if we're knocking on a door of recession. That then enables the government to spend more money on programs that they've already passed without the help of a bipartisan Congress. Another thing that could potentially happen, and we don't know this, is you could potentially, good Lord, you could potentially have a bipartisan effort on expanding unemployment protections in the event that you have an unemployment crisis. Now, these unemployment benefits would probably be conjoined with some kind of demand that individuals work. I don't believe that Congress is going to go back to the days of here's massive unemployment compensation for no work. I think there will probably be look for work requirements if Congress were to expand in a bipartisan way unemployment protections. But I think this would probably be the biggest stimulative effect that Congress would have on the economy. Is not only the Biden administration in their own way basically increasing stimulus checks that have already been written. Remember what Goldman Sachs said. They said, hey, we've got about $390 billion in stimulus checks that'll probably end up costing around $1.2 trillion because the Biden administration is just going to loosely interpret those rules. But I actually do think that Congress could, in a bipartisan way, increase unemployment compensation stimulus checks as long as people agree that they're looking for work. I think that's how you can get a pretty divided Congress right now, Democrats and Republicans on the same page and actually printing money again, supporting massive unemployment checks for people who have been laid off, especially in, dare I say, the tech sector. I think there's a chance you're going to see a high level of tech unemployment, and that's going to lead to higher unemployment checks to make sure people who basically funded, it's so frustrating, who basically funded a very expensive lifestyle. I feel like I'm taking a Nintendo Switch here. I've got expensive HDMI cables, expensive Apple dongles, but no. Oh, don't you just love seeing Kevin blow? Anyway, so there's this chance that you have the tech sector that has an expensive, much more expensive lifestyle, right? More expensive cars, more expensive apartments or whatever, that actually ends up fueling calls for higher unemployment checks because they're now unemployed and regular unemployment won't help them pay the bills they signed up for under salaries that they used to be used to because of unemployment caps, basically. So there is the potential that you see stimulus checks come back in the form of higher unemployment compensation, as long as, to appease Republicans, there's a look for work requirement. That's a potential. Now, what about straight up just stimmy checks? Is it possible, stimmy checks, is it possible that the Federal Reserve and Congress issue stimmy checks? Well, first you have to ask, would the Fed print more money in the event of a painful recessionary dynamic that lasts long? So in long recession, right? So let's say Q3, Q4, we go into recession. And by Q1 2024, we're still in recession. Basically, the Fed went too far. Is it possible that maybe instead of getting stimmy checks to the tune of, $1,200 and then $1,400, and then actually it was the other way around. There's $1,200, then we had the $600, then we had the $1,400 from the Biden step up, then you had the child tax credit, right? Is it possible that we end up getting a revisit of some form of stimmy checks? Maybe. Do I think it would ever be to the degree that we saw here? Very unlikely. It's very unlikely we would go back to this kind of stimulus. However, is it possible that there would be a one-off? Maybe. I think before you'd ever get to a runoff, and you would not want to pray for that, because I think we would be in a pretty deep recession if you prayed for that. But I do think they'd probably go back to some of the protections that they previously had, which were very inflationary. The expansion of the money supply is what created the inflation that we have today. But I think they would actually and potentially make the same inflationary mistakes that we had the last time around, just to a slightly lower degree. I think, though, you could almost say with certainty, okay? So let's put some odds on this. I think you could say with certainty that is like 99% likelihood, which is basically certainty, that they are going to, via the Biden administration, print their way out of whatever recession we're going into by dumping money, showering money into the chip sector and the energy sector. The Inflation Reduction Act was a ruse. It's not going to reduce inflation. It's going to increase inflation. But because they told Republicans it was going to be deficit neutral and everybody believed them, and now the Biden administration can loosely interpret every rule they want, there's going to be a massive amount of spending here. So if you're looking for a job, you're probably always going to be able to get a job in chips, manufacturing, EV, solar, hydro, you name it. Over there, I don't think there'll be a shortage of jobs, which I actually think is going to be fantastic if you're exposed to those kinds of stocks. Now, with maybe a 40% chance, I would say Congress actually works together to raise unemployment compensation as long as there are look for work requirements. I'd actually go as far as saying 40 to 60% in the event we're in a recessionary environment. And then stimmies, I'd probably say a one-off has maybe, under the Biden admin, maybe a 20% chance. But it would really require a dirty recession, so you probably wouldn't want to go down that direction. So that would be a little scary. So somebody here says, why would you stimulate? The truth is out there says, why would you stimulate the economy while at the same time slowing the economy? So the only way this really plays out, in my opinion, is that inflation is conquered. So inflation ends up proving to be transitory, right? So let me give you an example of what that could look like with data that's already happening. I want to pull up a NatWest piece, and then I want the costs for shipping. I have so much data on my iPad, it's insane, but it's somewhere around here. There, got it. That wasn't bad. Look at this. Shipping costs out of China I even wrote next to it, this is what transitory looks like, okay? That right there is what transitory inflation looks like. So I know a lot of people are going to say, hey, wait a minute. How could you possibly go back to stimulus checks if you have all this crazy inflation? Well, you can't. Here's how you go back to stimulus checks, okay? Number one, inflation goes away. Inflation goes away. Goes away. That's number one. So step number one is inflation goes away. However, to get there, oh, it's so annoying. However, to get there, you actually had to push the economy into a nasty recession. So let's write that. However, now in nasty, oh my Lord, whatever, man. You're in a nasty recession. So inflation goes away, and now you're in a nasty recession. Now that you're in a nasty recession and you have no inflation, guess what the government can now do? They can print their way back out, but less than last time. So that becomes the rule, right? So the rule becomes, look, we'll print, but we just need to make sure we're printing less than last time because we don't want to create the inflation again that we did last time. So let's draw that out for you for a moment. So inflation goes away. However, now we're in a nasty recession, so we want to print our way out, but we're going to do so less than last time. So imagine this. I'm going to draw a really big orange line here, and this is going to be inflation, okay? So let's say we get inflation that does this, okay? And then it goes negative. So we're actually at deflation. Well, now the government prints money via stimulus checks or increased unemployment or chips or EVs, whatever. So they print money to push inflation back up, and they basically try to cause that, right? That's the goal. Will they be able to accomplish that? Probably not. They'll probably screw something up because that's what they're really good at. But it could happen. It could absolutely happen that we end up falling into deflation, just like this chart shows you. I mean, look at this chart. This is shipping costs out of China plummet. That's what our inflation is probably going to look like. Now, is it possible that it'll look a little bit more like this, you know, where basically it stays higher for longer? You know, it could even to some extent kind of look like that, right? Is it possible? Yes. But if we get to deflation because of a deep, dark recession, I think they'll turn the printers right back on and we'll be right back to stimulus check 17. So yes, it is possible. But there's another thing that is possible as well. And it is you getting 12 amazing free stocks by signing up for Webull at metkevin.com/free. Checking out the amazing programs on building your wealth, link down below, where you get lifetime access and you can now buy now, pay later for them. You can get in for, I think, less than $40 a month for a very short period of time, which is phenomenal. Just check out all the different options linked down below. And you could get life insurance sponsored here for as little as, in as little as 5 minutes. 5 minutes, life insurance. You can Apple Pay for it now. It's easy to do. Check it out. Link down below. In the meantime, look at my beautiful banner here. Look at that. Meet Kevin, licensed financial advisor. Go to meetkevin.com to learn more. ETF, real estate startup, affiliates, all that good stuff. It's all linked down below. Why not go check it out? Support your favorite channel here on YouTube. All right. Next segment done. Thanks for leaving the comment. See, because whomever said that left a comment, I was able to cover a whole segment on it. So shout out to you. Thank you for calling my banner sexy. I love it when my inanimate objects are considered sexy. I'm going to walk away from that one.
Are you feeling better about the prospects for the stock market or even worse?
Well, it all depends on the path of earnings, because just because the Fed cuts rates or starts to ease policy, if you don't see downside to earnings estimates, that would be very, very bullish for risk assets, similar to what we saw in 2016 as well as 2019, where the Fed started to ease policy, but we didn't have an earnings recession, so stocks did great. Now, if we do have an earnings recession, that's where Fed cutting rates isn't actually bullish for risk assets yet. So what we have to watch is those estimates being revised lower with higher risk of recession in the wake of what's going on with regional banks. And we think one of the reasons why markets have been so resilient over the last few weeks is that you haven't seen cuts to estimates yet. Now, that may reflect certainty or uncertainty about what the ultimate impact of these regional banking issues will have on the overall economy.
The BlackRock, the stance that company is taking, if earnings are definitely, if estimates are too high, and we're definitely going to see some credit contraction, and we'll see, that a lot of the things the Fed has already done, we see they start taking a bite out of growth. Is that the right move for the Fed to just stay in this? Do you think they go another 25 and then 25 after that? Do you think that's the right move for the Fed, or do you think that they've been chastened maybe by what happened?
Well, we do think that the ultimate impact of banking issues will affect the credit channel, as you said, and that if you see loan growth roll over, that's typically consistent with the fact that you're going into a recession. The problem with that is that it is very lagging and it tends to move slowly. So if we think about the May meeting coming up, they'll only have March data to consider at that May meeting because the April data comes after they meet. And so if you see continued strength within the March data, which won't reflect any of this rolling over in loan growth, then the reality could be that May is still a very much a live meeting because they are still very much in this inflation fighting mode, as we heard.
Yeah, we'll see. We'll see. All right. Let's get to another topic here. Quick comment here. Somebody says, I was watching your video with Ben. Can you explain why cap rate determines the price of a property? Well, the easiest way to do that really quickly is just by example. Basically, if you had net operating income of $100,000 for all your rents and your property building was worth $1 million, you could divide that and you could say your cap is 10%. Net operating income divided by the price of the property. Okay, there's your 10%. Now, if the market gets 10% on treasuries, why would you buy real estate? So you'd have to, let's say, earn 20%. Well, if you want to earn 20% on a $1 million building, or rather a building that generates $1 million of cash flow, net operating income, then the price would have to come down. So if the market now demands a 20 cap instead of a 10 cap, well, with the 100K of annual income, a 20 cap would mean the price of that $1 million property halves as your cap rate doubles. So cap rate up, price down. Simple. All right, now we have to address the elephant in the room. It is American values. Yes, there's actually a piece on this I'm going to cover briefly, and then we got to talk AI and commercial real estate. I think we'll have time to do it all. Let's try to do it all. I want to do everything. The Wall Street Journal just put together a piece that really makes me concerned that a lot more people need to sign up for life insurance via the link down below, the sponsored link on signing up in this of those 5 minutes. No, actually, it's this piece right here that is a little disappointing. American values have pulled back, according to a new Wall Street Journal and University of Chicago poll. And I want to show you some of the takeaways here. Patriotism, religious faith, and having children and other priorities are receding in importance. Take a look at some of these charts over here, okay? So we're going to go through these. Look at this. Percentage of Americans who say values are very important to them. This is a 1998 study right here compared to 2019 compared to 2023. Listen to this. Patriotism went from 70% important to 61% important to just 38% important. Now, I actually think that's really sad. I actually fly an American flag on both my office and my home. I'm a big fan of America. I wasn't born in America. I'm an immigrant. I'm a big fan of the opportunities that America creates. So I'm very sad to see that. Now, who knows? Maybe is that because of people's frustration with politics? You know, have things gotten too divisive in our country? Maybe, but that's kind of sad to see. Religion. People who say religion are very important to them. Look at that, going from 62% in the last 25 years down to 39%. Religion becoming way less important. Yikes. Look at this one. Having children. What the hell, man? Having children halved in importance to people from 59 to 30. Dude, I want to have like 10 children. I'm like, Lauren, start lining up surrogates. Like, this is taking too long. Like, we need an army of children here. We only have 2. I need a 10x, man. I need 20 children. And she's like, but you said 6 when we started. And I go, clickbait. And she's like, all right, well, I'm used to that. Anyway, having children halved in importance. Like, what the heck? Community involvement has fallen in importance, down to 27%. Crazy. And look at the only thing that actually went up in importance, from 31% importance to 43% importance, baby. The big M word. Money, money, money. That's the only thing that's gone up in importance. How crazy is that to people? Now, there's a lot in this. Look at this. So we saw the patriotism decline. Only 23% of adults under 30 said having children is very important. Are you kidding me? More children. I will make up for this. Single-handedly make sure we have more children in America. I'll take it upon myself. That'll be my charity, is having more children. What else do we have here? Oh, yeah, there are some more polls here. Look at this. Percentage of these values are very important to them. Okay, we saw that that's a reformatted chart. Here we go. For each of the following, has our society gone too far, not gone far enough, or is it about right? And the following chart shows the people who say something has gone too far. So, accepting people who are transgender, Republicans say it has gone too far. Well, that's true. If you go on Republican TikTok or Twitter right now, basically everybody's like, that's it. Transgender people are now shooting up schools. And this is because of the disaster that just occurred in Nashville. Absolutely horrific. Thank God police were already on site clearing the first floor of that school before shots started being fired by an individual who had a rifle and a handgun. Thank God police were already on scene when the shooting began. It's still terrible that 6 people had to lose their lives. 3 8- and 9-year-olds, absolutely disgusting, and 3 adults who were in their 60s. Terrible, absolutely terrible and devastating. But anyway, you go on Republican TikTok, now everybody's blaming the transgender community, which that's not fair. And I know people are going through like the list of school shooters and stuff, and they're like, oh, well, look at all these people who identify in whatever ways. I don't like. I don't think that we could really take school shooters and identify and say that's it. People who are of one persuasion are definitely school shooters. I think that goes a little too far. But you do see that kind of stuff on the Republican TikTok and Twitter right now. I'm open to obviously your opinions on that. I personally, I have no problem with accepting people who are gay, lesbian, bisexual. You want to be trans? I have no problem with that. That's my opinion, right? It's totally my opinion. And so I actually think that could potentially go further. So I probably sit over here in more of that independent camp, where people are like, no, it hasn't gone too far. But it actually seems like a lot of Republicans agree with that. Only half of Republicans think acceptance of gay and bisexual has gone too far. So that seems to be pretty neutral there. Schools and universities taking steps to promote racial and ethnic diversity. This is the same question as then asked of businesses. So they asked the question of schools and universities and then businesses. And here there's a really big divide. So here you have Republicans who think, over half of them think this has gone way too far, but only 6 to 7% of those on the left think it's gone too far. I also, again, probably identify in the middle here and more of the independent camp. But yeah, I mean, they're like, I'm a big fan of merit. I'm a big fan of, I don't care if you're Muslim, if you're Jewish. I'm not Jewish, but I went to a temple as a child because I don't care what your religion is. I don't care what the color of your skin is. None of that matters to me. You know what matters to me is that you work your ass off. That's it. And the people around me who work their ass off, whether they know it not or yet, or whether they know it now or will know it, at some point they will realize I recognize it very highly and they will get substantially rewarded for that. But the point is, to me, I'm a big fan of hard work. Big fan. The people who work hard, it doesn't matter if you're Jewish or Muslim or Black or Indian or Mormon or whatever, right? So I'm a big fan of merit. And I do think there is a potential argument that forcing a diversity allocation might have gone a little too far. I think there's an argument to be made there where, skill-based jobs are potentially going in the wrong direction solely because of quotas that need to be met. So I do have concerns with that. And that's not to say that there shouldn't be balanced representation of opinions between men and women and people of different backgrounds. But we can't let merit be sacrificed based on that. That's my opinion. Maybe unpopular opinion. I don't know. At least I'll speak my mind. So I think this is a very interesting piece right here. And it's the saddest thing to me is probably over here, that you have a really big decline in patriotism amongst left people on the left and independents, and a massive decline in children across the board. All walks of life declining here in having children, and patriotism on more on the left and middle. Community involvement across the board plummeting, and then this increase basically in money as an importance from the 1998 levels. Probably unsurprising. I think some of that is potentially due to a cynicism of the system. So I think, like, the way I might explain this is, I think a lot of us are realizing we have to take care of ourselves. We have to become basically financially independent, that you can't rely on a union or the government to support you. And really, we have to rely on ourselves. So I think as a result of that, maybe we could say maybe that's why people see community involvement as an opportunity cost, maybe children as an expense. That's a terrible thing to say, but it's possible, right? And then less belief in government, possibly based on the extremeness that we see on social media and mainstream media, that basically divides our country more. So that would be my explanation for why we're seeing more of an interest in money, which is great for people like me who are encouraging people to check out programs on Building Your Wealth link down below, because I sincerely believe I could teach you how to become a millionaire, especially in zero to millionaire real estate investing combined with stocks and psych. I think anybody watching this can do it. I'm highly confident of that. Like, the road is there. You just have to go on it. But anyway, I think there is a potential that this cynicism that we're seeing in political parties and government is actually leading to a higher interest in becoming financially independent in our society. So I think that's very interesting to me. Somebody here writes that's the destruction of the nuclear family. Yeah, I think that's I know there are a lot of single parent households, and it's terrible. I think my parents divorced when I was 6, and I think divorce is terrible. I think single parent households are a lot more challenged, certainly, than the nuclear family, so to speak. Corporate wokeness to avoid litigation is being confused with ordinary morals. Yeah, I do think that has a lot of merit in what you're saying. I do think there's a lot of fear about litigation that's leading to a lot of policies that we see today. Hard to feel patriotic or desire to have children when you live in financial precarity, as many young people continue to do. This is true. Yeah, I mean, if you don't have money, you can't have children. Absolutely right. Absolutely right. Completely agree with you. The road is there, but not everyone can afford the tolls. Well, yeah, but I think there are ways to get to where you can afford, going down the path. Like, it's not everybody watching this can buy real estate in their life. It's just a matter of knowing how to play the game. That's why I have programs on Building Your Wealth is I'm trying to teach people how to play the game. It's a game. You got to know how to play the game to win. If you don't know the rules of the game, why do you think you're losing? Why do you think you're broke? Well, because nobody's taught you the rules of the game. Once you know the rules of the game, it's a lot easier to get ahead, in my opinion. Republican values from that poll seem more in line with core values that made America great. Steve, well, we know Steve. I mean, this is coming from Steve. This is commodities guy. That's okay. I mean, and Steve acknowledges that, his position. He's not bashful about his position. But I mean, look, having children and community involvement and patriotism and a merit-based economy, these are, regardless of your political persuasion, very important values. Very important values. So merit over immutable traits. For example, I personally think it's unfair. Not that I'd want to, but some people, when I ran for governor, they're like, "Oh, it's so lame. You can't run for president because you were born in a different country." And I'm like, I didn't choose where I was born. I didn't choose to be white. I didn't choose those two things. I have zero control over that. But no amount of merit will change the color of my skin or where I was born. And so to some extent, some people have alluded to the constitutional requirement of being born in the United States as almost a form of bornism. I'm not trying to call it racism, but that's kind of what some people call it. Kind of crazy. So crazy time to be alive, and sad to see some of those changes in the polls there. But that gives you an update on the change in American values from a point of view of the Wall Street Journal. And it makes me want to remind you to check out all of the things and services that you could be offered by going to meetkevin.com. Learn about my real estate startup. If you're a accredited investor, we got a deadline in 3 days. My actively managed ETF, my courses and live streams on building your wealth, and affiliate links like metkevin.com/free to get 12 free stocks, and metkevin.com/life to get life insurance in as little as 5 minutes. Damn, that timing was good that time. All right. Very good. Very good. What's next? What's next? What's next, girls and boys? Let's find out what is next. The next topic that we have to cover. Oh, God. Ooh. This would be an interesting one. Yeah, all right. We'll do this. We'll end on commercial real estate. And then we will go to the course member live stream. That banner gotta go. Why banner gotta go, Opsar? What's your problem with the banner, man? I won't have a beer with you. I'll have a coffee with you. Yeah. All right. Is the commercial real estate implosion upon us? And how much could apartment buildings drop in value? How much could commercial real estate drop in value? How about industrial? How about retail? How much could office spaces drop in value? Well, we've got a new report, multiple new reports here, but one in particular is going to give you exact percentage forecast for where the pain could be coming in real estate. So let's get into the topic. Keep in mind, I am a licensed real estate broker, but not only am I a licensed real estate broker, I run an actively managed ETF. I've got courses on building your wealth, especially 0 to millionaire real estate investing courses linked down below. I'm a licensed financial advisor, and I've got a real estate startup. So real estate is absolutely near and dear to me. And because we're sitting on cash at that real estate startup, we're ready to buy sweet, sexy deals in real estate. I'm sharing that journey with you of where we ultimately want to buy and the research that we're studying. So without further ado, let's get into some of these reports on commercial real estate and where the stress is coming from. Because, well, it's a little bit of a problem. We'll also talk about housing. In fact, before we talk about that, commercial and industrial and stuff, let's do a quick little snippet here on housing and what's driving this sort of segmentation in real estate that we're seeing. Look, we know rates have gone up. Real estate rates have gone up, which have made real estate more unaffordable. We know that housing prices have fallen more in the West Coast in areas like Phoenix, in areas like Austin, Boise, Idaho, some of the work from home places. California has been hit. But we also know that parts of the country like Florida have actually been holding up and doing pretty decently. So what's happening here, and why are we seeing this divide? Well, according to Bank of America, when it comes to single-family housing, one of the reasons we're seeing this divide in this Sun Belt area is the following. Median rents and mortgage payments for all Bank of America customers were up 8% and 7% year over year, respectively. But some Sunbelt regions are seeing a bigger surge. In Phoenix, median rent payments grew by 26% year over year, compared to just 2.5% in San Francisco. That's a big deal, especially since home prices in Phoenix are down about 20 to 25%. That's quite interesting from peak, comparing back to May. According to Bank of America's internal data, mortgage payments show a similar regional divide. So why have some areas experienced a much bigger housing boom than others? And one underlying reason may be complex, but we propose some potential explanations. Domestic migration has been driven by affordability, above average unemployment gains, and an increasing share of higher paid jobs. And so really, they're making this idea that rent payments are potentially growing where the jobs are growing. Okay, well, what a surprise. Well, where are those rents and jobs going? So let's take a look at this. Median rent and mortgage payments based on these various different areas in the United States. So, and we're going to align this with home price declines here as well in just a moment. And I'll show you this. I'm going to pay a specific attention with a green circle to this region right here. Look at this. Rents up 23%, 20% Atlanta, Orlando, Tampa 23%, Miami 16%, Dallas 18%, rent in Austin up 21%, Phoenix rent up 26%, Los Angeles only 6%, and rent in San Francisco only up 2.5%. So why are we potentially seeing this lower region over here blow up? Well, a lot of folks are saying the reason for that blow up is because of jobs. Offices going to Austin, Dallas, new offices going to Miami, Tampa, massive job growth on the right lower side. So the right side of the country in the South, the Sun Belt region, because of an availability of jobs. However, recent studies have shown that only about 3% of jobs in Florida, or I should say Tampa specifically, or 10% of jobs in Florida in aggregate are actually advertising the potential for work from home. So this is creating a really interesting spread where basically work from home drove a boom in many areas, Idaho, Phoenix, Austin, Florida. But that work from home is going away in areas like potentially Austin and Phoenix and Idaho, and staying, and the jobs are going to places like Florida, where that work from home trend is potentially going away. And one of the ways we could see this before we get into the commercial industry sector is we can look at median sales prices on the Redfin housing data app. And I want you to show some of the trends. I want you to see some of the trends we're seeing. So these are the trends right now. We can see housing prices slowly starting to pick up at the beginning of the year here. They're not moving flat as we potentially expected they would. They're actually increasing nationwide, which is quite interesting. There's technically negative year over year right now, but not terribly much. But this goes a little bit more extreme when we jump into individual regions. Watch this. Let's go into Phoenix. You're going to see an interesting switch here. Look at Phoenix. In Phoenix, you have a flat level of pricing growth, which means you are actually looking at negative year over year pricing, right? Pricing you sat around 468,000 in Phoenix, now down to about 427. Peak to trough, it's even worse. You're looking about 490 to about 427, right? So if you go 490 to 427, you're down about 13%. So maybe not as much as that 20% that had been estimated when we compared to the end of last year. So this is the Phoenix area. Now look at the area like Austin, Texas. What do you see over here? Austin, Texas, from peak to trough, 439 from 574. Go 439 to 574. You're looking at that about 23% drop. Where are you not seeing these kind of drops? Well, watch this. Go to Miami. Go to Miami, Florida. Look at that. Prices are higher in Florida than they were last year compared to Phoenix, which is negative, or Austin, Texas, which is negative. Let's do another one. Let's look at Tampa. Look at Tampa. Prices are higher this year than where they were last year. So Florida is killing it. So how do we reconcile this housing disaster from a residential point of view? And how then do we compare that to what's going on in the commercial space? And then we'll get some more data as well. So in my opinion, what's happening is the following. What you're seeing is in work from home areas, you saw a boom and then a big bust. And now with less companies offering work from home, you're feeling that pain. So you potentially have more price sliding to do in very work from home popular areas, like, for example, an Idaho. Whereas in California, you already had this substantial boom that was accelerated a bit, but that drop is probably less impactful because people are moving to, let's say, Southern California for reasons outside of work. Work and affordability aren't driving migration into California. They might be driving migration out of California for sure, but the net reason people stay is generally outside of the reason of work. And so that might be why you see a little bit less of that bubbliness in California. Whereas now in Florida, you actually see a boom that is continuing. And why is that continuing? Well, potentially because people who are looking for more affordable housing and a more affordable cost of living structure, combined with the opportunity for jobs, are going to Florida, because Florida is not offering that same kind of work from home as other states were. So you have more of a boom and bust in the work from home states, more stability in California, but more of a boom in California, but more of a boom continuing in Florida. That's what I'm seeing, and I'm seeing the same thing as I travel the country on the ground. Let's look at some more data here, and then we'll look at some commercial stats as well. Take a look at this. This Bank of America piece explains that affordable housing could be what's driving people to these southern cities. Look at the boom that's happening in Atlanta or Florida, for example. Completely agree with that. These markets are still considered affordable, so even more room for markets to increase. Atlanta, Dallas, Tampa. They do have Austin and Phoenix in here, but I just want to put my own asterisk on top of that report because of that work from home potential. Orlando, Miami has become a little less unaffordable already. Then we have more jobs, more income, more housing demand. Absolutely makes sense. And higher paid jobs are creating more of a boom here. Where are those higher paid jobs? Look at this. Total non-farm payrolls, 12-month moving average. Total employment in Tampa and Phoenix was around 7% higher than compared to January of 2020, compared to just 1% for the national payrolls growth. So here you can kind of see some trends of some areas where you're seeing more of a booming employment growth. Just be careful because some of this I think will change in 2023. So I stand a little bit in contrast to some of the information from Bank of America. Here we've got a Wall Street Journal piece talking about the tale of two housing markets. This is more of what I'm talking about, where look at this, where you could see a little bit more of those increases over here on the right and potentially more pain in the West, especially Silicon Valley. Silicon Valley, in fairness, is getting hit. Less so in SoCal. More stability here in SoCal for the weather, more pain in Silicon Valley. Here you've got maybe the work from home pain. Here you've got where that Sunbelt boom is happening, with the exception of Austin. Austin is really tech exposed like San Francisco. But then you go to like Dallas, Atlanta, or Atlanta over here, and then Florida. That top one is more like Jacksonville right there. Cities have become closely associated with tech are experiencing the biggest falling of home prices, whereas Florida and southern markets are still attracting individuals. This makes a lot of sense. Many economists expect home prices to fall further on an annual basis this spring or summer. But now a lot of this information, metro areas in the Southeast that experience big price run-ups like Nashville or Raleigh are especially vulnerable to price declines. The speculative markets that are not potentially in areas like Florida where jobs are still going. That's very interesting. So big sort of takeaway here so far is Florida looks really desirable, and so does Texas. And that seems to be where a lot of potentially jobs are going. But it really also aligns with what we're seeing over here with what's going on with property prices. And I find this really interesting. This piece from Morgan Stanley, look at this. This piece from Morgan Stanley tells you that property prices could decline or have been, this is retail, commercial real estate prices. And this, I think, gets affected, by the way, by the boom in work from home, which is hurting a lot of office spaces. But the one place office spaces could potentially still hold up might be Florida, where you're getting less of that work from home. But listen to some of the projections from Morgan Stanley here. Morgan Stanley suggests that property price declines this cycle have averaged 1.32% per month, tracking worse than the great financial crisis. The global financial crisis had less property declines on a monthly basis than what we're seeing now. It's pretty wild for commercial real estate. They expect that office prices will fall 40% in the total 24 months of this cycle, compared to 34% of the global financial crisis. So in other words, bigger declines for offices this cycle, suburban prices falling 40% for offices, apartment buildings to fall 15%. That's less than the 30% fall during the great financial crisis. But they do expect weakness in apartments. Bank of America also talks about office REITs and apartment REITs experiencing more pain potentially than we saw during the great financial crisis. There's also a talk that REITs, especially apartment REITs, are selling at a little bit more of a premium than they otherwise should be. Retail stores, potentially a 30% peak to trough decline. Industrial, a 15% decline. And then overall real estate, including residential real estate, potentially an average 15% peak to trough decline. But I think the biggest and the coolest chart out of all of this to pay attention to is where the pain is happening and where jobs are shifting. And personally, I am very interested in Florida because of the changes that we're seeing. And one of the things that makes me really excited is my opportunity with my real estate startup to basically fly my plane to Florida. And once we're in Florida, we can hop around and explore Florida like crazy. And I grew up in South Florida, so I'm a big fan of the Florida markets, huge fan, much more than I thought I would be. And the chart's showing us that the Sunbelt regions are booming. We're going to be something we really want to pay attention to. So with that said, there's a lot of a big shift and mix-up happening. I think COVID basically threw all of real estate up in the air, and it's going to be really interesting to see where it all falls. But I'm watching it really closely, and I'm particularly interested in what's going on in Texas, Atlanta, and certain cities in Florida. So stay tuned, follow the channel. I think there are going to be great opportunities. Check out the programs on Building Your Wealth, linked down below. Now we're going to run over to the course member live stream for the bell. Thanks so much, and we'll see you in the next one. Bye.